Hello, everyone. Welcome to the second event of our Fall Fuel series. I'm so glad that you're here with us today. My name is David Kenny, and I'm the Executive Director of Virtue Lab, the host organization of Fuel. Last week, we held a session on tech startups and university collaborations. That session is now available to watch on our YouTube channel. A link will be in the chat near the end of the session today. By signing up for this event series, you're also already signed up for next week's session, which will be a startup pitch showcase featuring the companies in our accelerator program, the Cascadia Clean Tech Accelerator, which we run in partnership with the Clean Tech Alliance for 7 years. Our annual event, Fuel, is an opportunity to bring together future-focused leaders, entrepreneurs, and innovators, and investors who are tackling the climate crisis and other environmental issues. I'd like to begin today by offering a land acknowledgement as an expression of gratitude and appreciation to those who have stewarded the land we are on from time immemorial, including the land I am on here in Oregon, as well as the land upon which all of you are on who are attending today's virtual event. Land acknowledgements are not just an historical recognition. Colonialism is a current, ongoing process, and we seek to build an understanding of our present participation in it. Portland, Oregon, where I live, covers a broad area, which has been and continues to be the home of many tribes, people, and villages. We honor their history and acknowledge the sacrifices they made. In the metropolitan area, the tribes are Multnomah, Wasco, Cowlitz, Cathlamet, Clackamas, Chinook, Tualatin, Kalapuya, Molalla, and many other tribes who made their homes along the Columbia and Willamette rivers. We wish to acknowledge the robust, present-day federally recognized tribes of the area, the Grand Ronde, Siletz, and Cowlitz. In addition, we'd like to acknowledge the Chinook Nation, which has been seeking federal recognition for many years. Today's Native American community in this region is made up of tribal diversity that originates from around the country, representing hundreds of tribes and a vivid history. Land acknowledgements provide an opportunity for all of us to express our appreciation for those who have stewarded the land, and can be an encouragement for us to seek out a greater understanding of the history and stories of those people, past and present. Today's topic at Fuel is the climate tech boom and impact investing, what you need to know. Why are we talking about this topic today? Well, I think you know the climate crisis demands solutions that utilize new and innovative technologies. Conventional capital has not met the needs of this sector, so we need catalytic capital for climate tech to help get promising companies off the ground and technologies into the marketplace and up to scale. We need a lot of innovation, and we need a lot of different types of capital to meet the needs of developing technologies, bringing them to market, and scaling them up. Virtue Lab is an active investor in early stage climate tech startup companies through our Climate Impact Fund 1. Our next fund will expand the range of company types and that we'll invest in and the investment types that we'll make. There's a lot of different types of capital out there in both the conventional investing and the impact investing space. Today, we're going to talk about how impact investing uses a variety of tools, including grants, debt, and equity investments to support climate solutions. Today's session will include two panels. The first will focus on the needs of businesses that need early stage capital, both in technology development and also those that are getting started in deploying solutions. I'll moderate that first panel, and then Ken Vaughn, Virtue Lab's Director of Impact Investments, will lead a discussion with our second panel about the variety of sources of impact capital available. I'd like to introduce each of our panelists with their name and title, and then let them introduce themselves a little further with some information about their company or organization. First is Jane Malia, who's the CEO of Harvest Thermal, a company in which Virtue Lab invested via our Climate Impact Fund. Jane, can you join me on stage?
Absolutely. Hi, David. It's a pleasure to be here. Thanks so much for the invitation. I'm really looking forward to this session. Do I say a couple of words now, or?
Yeah. Could you tell us a little bit about Harvest Thermal?
Absolutely. So I'm the CEO and co-founder of Harvest Thermal, and Harvest's mission is really to help homes transition from gas, heating, and hot water, and do so in a way that's comfortable, cost-effective, and scalable. And so we really help homes transition from gas to electric while saving money and while slashing emissions dramatically by about 90% per home, and also doing this in a way that supports a strong and renewable electricity grid. So we're currently rolling out our product in California and hope to come up to Oregon in the not too distant future and deploy some homes up there as well.
Terrific, thank you. Our next panelist is Maurice Raming, who's the president of O'Neill Construction Group. He's also a co-founder of the Professional Business Development Group, which is a partner of Virtue Lab, and he's a Virtue Lab board member as well. Welcome, Maurice. Could you maybe tell us a little bit about your business and some of the businesses you work with through PBDG?
Yes, thank you, David, for having me. My business is a construction business. We specialize in commercial and industrial work. We do a lot of design build and used a lot of technology within, whether it's NavWorks and building informational modeling that's becoming extremely popular. PBDG is a business organization to help minority and women businesses be successful in the industry. So that's a little bit about me and a little bit about my businesses. Thank you for having me.
Thanks, Maurice. And our final panelist is Allison Arnold, who's an impact investing manager at Virtue Lab and was formerly a program director at E8, which is a clean tech angel investor group. And prior to that, she was the executive director of the Washington Solar Energy Industries Association. Allison, welcome.
Sorry about the technical difficulties there. It's the good old unmute button. I'm honored to be on the panel today. Thank you so much for including me. I'm, as you said, impact investing manager at Virtue Lab, and I work with Virtue Lab in helping them on a key component of the mission, which is unleashing innovation by providing the critical funding that clean startups need, where traditional funding fails to invest because of high risk. So we are doing that through the Climate Impact Fund, which is investing in companies that are raising their pre-seed and seed rounds. Those are companies that have typically raised money from friends and family. They may have received government grants, but often they have yet to generate revenue.
Perfect. Thanks, and welcome to all of you to our panel, and I really appreciate you being here with us today. I'm really interested in talking about the types of capital that you've either been able to tap into or that you recognize as are important for the types of companies that you are or that you work with in your day-to-day work as you're trying to help bring the technologies to market that will help address the climate crisis. And Jane, I'll start with you. Maybe you could talk a little bit about the types of capital you've been able to tap into, and also what how you see the role of impact investing capital as part of the types of capital available to companies like yours.
Yeah, absolutely. Great question, David. So first of all, impact capital is just so essential for companies which are either new, early stage, or doing something a little bit different to what most investors may be familiar with. And let's face it, to fight climate change, we have to do something a bit different to what we've been doing so far. So it does require a different type of investor. And I would say there are two main reasons why it's really valuable to be working with impact investors. One is because the assigning a value to the impact of the system of the company, but also have a bit more patience in terms of returns for the company while still looking for a good financial return. But what I've also found in working with multiple investors and engaging with them is that by having this focus on impact investing, they also have a deeper knowledge of both the problems and the opportunities and the whole space from a regulation and an incentive perspective, which gives them a bigger, better perspective on where this can take us, what the impact can be, and also what the financial benefits can be for all of us as a society. So at Harvest, we've actually, been able to leverage multiple forms of impact investing. And the first type was grant funding. And so grant funding from National Science Foundation, also support from some of the utilities was instrumental back in the very early days when we were pre-product, but really had a good design, which was very impactful. And that has continued, right? We do continue to look for and appreciate the grant funding that we're able to get. Then there's the impact investors such as Virtue Lab, right? With a clear understanding of what are the benefits in terms of emissions, the timelines to achieve that, obviously holding our feet to the fire in terms of reporting and making sure that we're really focused on delivering that, while at the same time looking to build a business that's going to be able to scale and have that impact. And there's another group, which is also some of the angel investors. So there are a number of angel investors which are very mission-driven and focused on various impact topics. Some can be diversity, some can be climate change, some can be health. And that, again, you tap into some of the same motivations, which is the desire to invest in something which is going to have that double or triple bottom line of financial return, but also climate return, societal return, and often have the freedom and the knowledge to really be able to jump in at the early stage where some of the venture funds are not able to do that. And finally, one last thing is SBA loan, right? We have a small SBA loan that's been great in terms of working capital that we pay back. It's very low risk, but it gives us that financial flexibility.
That's terrific, Jane. Thanks for sharing that. It sounds like you've tapped into a variety of different types of capital, which is a great illustration of the diversity of capital types out there that are needed. Maurice, I'm wondering if you could share a little bit. Your company is very different. Jane's bringing a new technology to market that has sort of on a path that could lead to more traditional venture capital style of investing. Your business is more of a project-oriented construction industry business, and you work with other similar types of businesses. Yeah, they're a critical part of delivering climate solutions. I'm wondering if you could share a little bit about the types of capital that you and others are tapping into, and is there an importance that impact capital be part of that?
Yeah, and I think the thing is especially, I think definitely playing a part of it. What I think some of the challenges that the businesses, and especially smaller businesses I work with, is that there is a lot of technology that it's built into these buildings currently, as far as the energy efficiency. Most buildings today are just large computers. So as we look at the need for the software that's associated with it, the LiDAR technology that's associated with it, there's this major need for them to be able to have those type of impact investors actually look at that differently. I don't think it's necessarily an area that's currently looked at, but I think it's an area that in order for businesses to be successful, they're going to be needing more help as far as financing some of these. I could take my company, for example. It's several $100,000 worth of investment ahead of the outcomes. And so with a very small companies, this is a big lift. So I think there's an opportunity to have more impact investors participate in the construction industry.
Yeah, thanks. That's really interesting. It's, I think, one that I know in the space we occupy, we don't often consider enough, I think, in terms of where some of the barriers are to getting these technologies to market, and what especially a capital barrier that you just mentioned. Allison, you've worked with a whole variety of different types of companies, from solar installers to tech, high growth tech startups, and a variety of things in between. Have you seen impact capital being sort of a different kind of play a different role than conventional capital, and how have you seen the important role for startups, and what do you think are some of the most sort of common needs for companies that are in that early stage?
Sure. So in my current role at Virtue Lab, I'm certainly seeing the need for impact capital. Since we are evaluating deals that are in the pre-seed and seed stage, these are companies that are really just getting off the ground. So they typically have received small business innovation research grants. They may have raised funds from friends and family, but they've reached that point where they're ready to take their business to the next level. And so tapping into impact capital can be extremely meaningful for them. I see investors who are deploying impact capital across a spectrum. So they may be investing in some opportunities, looking for more market rate returns, and whereas they may also invest in deals that their expectations are lower. They're taking a more philanthropic lens towards their investments.
Great, thank you. I think part of raising money for our business often involves some rejection. Unfortunately, we don't get a yes every time we ask for money, and so I'm curious, what are some of the reasons for being turned down that you've experienced, especially from conventional investors? And I'd be curious to hear what some of the concerns expressed by those investors are, and is there a way that impact investment capital can help to overcome some of those barriers, so that conventional investors may be part of the solution later on? I don't know if any of you want to jump in on that one first. Looks like Jane might.
I'm happy to have a go once I find the unmute button. So there are a wide range of investors out there, and they all have their thesis. And so one thing is make sure that you understand, what their investment lens is before spending too much time of their time and your own time on them, because they may not be a good match. But I think some of the main challenges that I've encountered as in fundraising for Harvest Thermal has been that fighting climate change requires changing infrastructure. It's software can certainly help, but it's not just a software change. As Maurice has mentioned, we need to swap out some of the devices we have in our homes or our vehicles or our buildings, and that requires physical devices. And a significant number of investors are a little cautious when it comes to actually building stuff. It may have a longer lead time. You have to be more cautious in the ramp up, and it requires a broader range of skill sets. So I think the biggest gap and the biggest hurdle that I've had to overcome is that we're building a physical product, which of course has software and controls and machine learning and all that stuff in it, but it does remain a physical device because we need to swap and get gas systems out of homes. That has been the biggest challenge, and that's where I see a biggest gap remaining, and that's where grants and impact investors are really, really important and will, I believe, remain so.
That's great. And we did an AV check at the beginning here. I didn't factor in that the Earth was moving, and the sun's now streaming sideways across my face. I'm sorry about that. Any other comments from any of you about sort of those those no's that you might get from investors, and especially in other types of businesses that you've experienced?
Yeah, I can comment on that. I want to just echo Jane's comment about how different investors look through different lens at an opportunity. And so my understanding is that there are now nearly 200 VC firms investing in climate tech. And they each have a look at opportunities in a slightly different way, depending on the expertise of the people behind the fund, the changes that they're hoping to make through their investment in the world. So finding the right investor at the right that aligns with the work that you're doing, but also aligns with where your growth stage is quite important. I find that a lot of entrepreneurs, while they have the technical capability and brilliance, often have a difficult time conveying their innovation to investors who are frequently technical people, but may not have that exact technical expertise in their background. So some entrepreneurs are challenged to articulate what the core innovation is behind their technology and why it's significant. I've noticed that entrepreneurs who have participated in accelerator programs or are serial entrepreneurs have really honed that storytelling capability. So I think there's a lot of value in organizations that are helping entrepreneurs on that journey through support beyond just funding. And the other trap that I think entrepreneurs fall into when it comes to interfacing with investors is wanting to sell the product rather than the business. Investors really want to know that the product is differentiated, that the invention is protectable, as much as they want to know the nuts and bolts of how it works.
That's great. I think maybe you were coming off mute, Maurice. I don't know if there was something else that you wanted to add to that question.
Yeah, no, I was just going to say one of the challenges that we have is just the long tail as far as the return on that investment. So whether it's a large solar project or whether it's looking at a building and finding out all the different systems that we can do to reduce energy costs, but then the reflection of, okay, well, that tail seems longer than what they feel comfortable with the return on the investment. And so that's one of the challenges we're faced with.
David, could I add one more thing? Do we have a minute?
Yeah, that'd be great.
Yeah, because I was just thinking of all the entrepreneurs out there in the audience and the things, the hoops you have to jump through to make sure that your company can deliver and be funded. And I think one of the challenging ones that as a product developer, with an innovation, you can sometimes underestimate the importance is that go-to-market strategy, right? You sometimes think this product is game-changing, it reduces costs, it reduces emissions, a lot of things are happening. And then a fair level of detail is asked about, well, exactly how are you going to be able to sell it? Exactly how and when and through whom and why are you going to be able to make revenue? It's a really important topic, and it's actually a lot more difficult than as an engineer. I'm an engineer, you would think of, and that is actually a key that really has to be unlocked before you can get significant funding, at least in my experience.
Yeah, thanks for pointing that out. I think there are definitely some deeply technical folks who underestimate the challenges on the business side. When I think about impact capital, I often think what differentiates it from conventional capital, and I think Maurice, you pointed out something really important, which is the time it takes to get the return, that patience. We often hear about patient capital as being really critical, in addition to willingness to take on earlier kind of stages of risk. And so that I'm glad you pointed out the time frame. And Allison, you mentioned something about the dramatically increasing number of venture capital firms investing in climate tech that we've seen just in the last, it seems like 2 or 3 years. Felt like every 2020 and 2021, there was like every week there was another announcement of a large venture capital fund launching, focused specifically on climate tech. So we're seeing a lot of money there. And the other area we're seeing a lot of money is from the federal government through the Infrastructure Act and the most recent Inflation Reduction Act, which is now pouring over the next several years. It's not all going to hit the ground at once, but over the next several years, we're going to see hundreds of billions of dollars of federal resources going into addressing the climate crisis. It might lead some to think, oh, great, we solved the problem. And I'm curious if we can get a take from any of you. Are there still gaps even with all that new venture capital and federal funding? Or do we still have work to do to solve the climate crisis? And Allison, maybe you could start with that from your perspective.
Sure. Yeah. Well, first, I can't say enough about how important the Inflation Reduction Act and the Infrastructure Act are at supporting climate tech. Businesses dislike uncertainty regardless of where they are in their stage of growth, but uncertainty is particularly acute for startups. 60% of startups will fail to make positive returns. And so this federal funding is really a vote of confidence in the climate tech sector, and it goes a long way to alleviate some of the uncertainty that's out there among the early stage businesses, but also goes some way to alleviate uncertainty that we're seeing in the current macro and economic environment. However, what's been put on the table are subsidies primarily, and subsidies that are significant. They go as far as reducing the costs of some of these technologies' deployment by, I think, an average of 40%. But there are still really important policy wins that need to be seen at the federal, state, and local level in order to see effective deployment of climate technologies. One that I've had a lot of experience with in my vast career is policies like net metering, which allow residential and small commercial customers to feed electrons back into the grid and get credit for that. So robust net metering policies across every state are as important to the growth of distributed solar as the incentives are to buy down the cost. So there's also the role of building codes in setting expectations for what technologies will be deployed. So those are the gaps that I see beyond this generous funding support that's being put forward by the federal government.
Great, thank you, Allison. I'm curious if Maurice or Jane, if you have thoughts about either the growth in venture capital or in the federal funding, and both the positive implications of that. I think Allison really pointed out that it's really, really valuable and important. And I don't want to focus in on the negative, but I think there may still be some gaps out there, and I'd be curious to kind of get your take on where we still need other types of impact investors to play a role.
So I'll go first, then Maurice. This is tremendous. This is the biggest investment in the climate that we've ever seen. And I think it's needed, but it's also will be a dramatic improvement, and gives us a lot of hope regarding where we're going. So I think it's amazing. What I'm seeing already is it's expanding the conversation with investors from the impact investors to beyond that, because it becomes that proof point oh, there really is a market. It's, some of these, I think the tax credits, I think they all have a 10-year life, which gives them that predictability, and also underscoring the importance of the issue and the reality that change is happening, and therefore it's something that is investable in. And so it's bringing a lot more, not just the tax credits and the incentives, it's bringing a lot more capital in for the early stage companies as they develop their product and develop their feature sets. So that's phenomenal. I guess, one thing I would go back to is hardware always is longer and slower. And that is one area which is always going to be a little bit more difficult and will likely always have a little bit less access to funds. So that's one area that I would really support. And I think the other one is almost, I don't want to complain about good fortune, but there are a lot of different things out there, incentives in PCE territory and in MCE territory and others. And I know at Harvest, we have somebody, and part of their job is trying to keep track of that, working with people. I know there are people out there who are trying to make this streamlined and easy and seamless, so people know what to expect and don't have bad surprises for not getting incentives they were expecting, would be really helpful.
One of the things I would add to that is that I think it's great and especially on the federal side. I think the key, what I would say my caution flag would be is just to ensure that smaller businesses are extremely nimble and actually are able to maneuver and recognize the opportunities, that there is a space for them. A lot of times what happens is it tends not to get to those micro businesses, and so making sure the micro businesses can participate, I think that's where we'll see a lot more innovation come from, and because there's just quite honestly there's a little bit more hunger to make it happen.
Thank you for that comment, Maurice. I really appreciate that, because I think one of the challenges I know I've seen in this federal arena is the, regardless of the dollar amount of an award from a federal agency, the overhead involved just to apply is substantial, and small businesses have a lot to overcome to even access that, and to deploy the amounts of capital that are moving will often, it'll be easiest for the federal agencies to be doing it in very large chunks, on the order of, many millions or billions of dollars at a time. And so, I think there's going to be obviously subcontractors and subcontractors on projects, both grants and, other types of funds deployed, but ensuring that the capacity of small businesses is there for them to be able to participate is going to be really important. You also flagged, Maurice, earlier and actually I'll pause here for a second and say that if anyone has questions from the audience, feel free to put them in the chat, and we'll try to incorporate some of those into this panel here in the next few minutes. Maurice, you pointed out the an interesting need early on of companies that are smaller businesses that have significant technology investments they need to make. That's hard to capitalize and and sort of justify on a project by project basis. It's the way that project financing works, and there's a significant upfront cost for them to do that. I think that was a really interesting kind of case for a specific type of expenditure needed for a type of company. I'm curious. I also appreciated your comments, Jane, about the importance of sort of the business side, the marketing, go-to-market strategy. How do we actually figure out who's going to buy this and how are we going to sell it to them? I was wondering if Jane or Allison could talk a little bit about the kind of the expenses that a business has that maybe aren't covered well today. And I think the grant funding you got from NSF, Jane, that you mentioned, I know there's a lot of restrictions on grant funding, what you can spend the money on, what you can't spend the money on. And I'm wondering if there's specific types of expenses out there that are especially important that aren't necessarily covered or prioritized by other types of capital that impact, again, coming back to impact investing, where it can play an active role in helping to fill those gaps.
So we've built a kind of mosaic of funding, which is targeting different areas. Where I find the grant funding has been extremely powerful are the things that might not necessarily be so visible or appealing maybe to other investors, such as let's ramp up that manufacturing floor, let's go through this certification, and all of these things take a lot of work, a lot of engineering work, a lot of also process work, and it's actually but are very well suited to grant funding, and that's been really important for us. Whereas developing new feature sets, expanding the market, that's something that really fits well into the private investment and the investor funds. So I think we primarily split between that, which is the grant funding has been, I guess, what people think about as the back end. Maybe they think about it as more boring, but it's just so foundational to bring a product that's to market that's going to be scalable, reliable, and cost effective. And that's really, we've been able to support that by grant fundings because there are grants really dedicated to that. The other gap is the working capital, and we've been able to address that with an SBA loan. They are really important. We don't necessarily need a lot of it, but it's really important to have that loan so that the other funds that we have are able to be freed up to use for other things. So the working capital, basically the cost of the equipment that we have to buy, the product that we have to invest in before it's sold. So it kind of comes back and pays for itself, but really important to have that in place. So the mosaic has actually worked very well. I think had we not tapped into those three areas, it would be more difficult for us right now.
Great, thanks, Jane. So I just saw a question in the chat that I thought was really interesting, and it talks about the challenges for businesses related to governance and shareholder primacy, sort of some of the traditional capitalist approaches to growing and financing businesses. And so the question is really around, are there innovative impact investors and other stakeholders that are supporting changes to the way we think about sort of the role of capital, and not necessarily making shareholder primacy the primary goal. So supporting policy changes, albeit entrepreneurs prefer collaborating with investors who also have deep purpose. I'm curious if you have experience working with folks who are explicitly trying to provide capital in a way that's not driven by maximizing profits at all costs. I mean, it's sort of the very definition of an impact investor, I think. But I'm curious if you have sort of thoughts about navigating that, where most impact investors are wanting to get a return. Sometimes they're okay with a lesser return than others, but there's on that spectrum. If you had experience navigating that kind of shareholder primacy question. So
I'll start with this one. So a number of our investors are impact investors, and so obviously they're investing in the company to allow us to grow it, but they're also expecting from Harvest reporting regarding the benefits in terms of things like mid to low income homes that we're able to deploy in, the amount of GHG emissions that we're able to reduce, the bill savings that we're able to deliver. And that becomes part of our reporting for these investors. And that's actually really valuable as a CEO, that my feet are being held to that fire, because Harvest Thermal is built around that mission. But you can get so focused on the day-to-day operation and the strategy that having to take a step back and make sure that we are monitoring and reporting on that is really key. But I would say fundamentally, for us, the key thing has been having a mission first and building a company that helps us meet that mission. The mission being, where I'm sitting right now in California, 90% of small or single family homes or small multifamily homes, maybe 85% are using gas for heating and hot water. And that's not going away, right? It's not going to get any cleaner, whereas electricity is getting cleaner every day. And so we have a mission, which is how do we make this transition happen in a way that's going to be scalable, so not just for the well-meaning, well-off, but for as many people as possible, and really have an impact. So inherently, we have a company whose mission is really aligned with the impact investing. That is a good position to be in. I would hate to be in a position where there's a conflict between the impact of my company and the benefit to shareholders. And so I think it's kind of thinking at the core about, if you're building an impact company, how will you be measured, and how is that aligned with the benefit to the company? The more Harvest scales, the bigger benefit we have from an emissions perspective, and that's really important to me.
Thanks, Jane. That's great. Maurice, you've seen a lot of different construction projects, and I know that the project financing usually involves sort of a targeted financial return with different variety of different types of often equity and debt investors participating. Have you seen projects where impact investors have been part of that capital stack and have been able to provide concessionary capital, a lower rate of return that brings the total cost of capital for the whole project down in order to achieve some social or other impact objective? And I apologize in advance if you haven't, because this wasn't a question that we were preparing. But I've certainly heard and read about that being a way that we can finance building and construction projects, and I'm curious if you've come across that in your work.
Yeah, I'm sure it's happened on a number of our projects. One of the things I would say, what I see is like some of the biggest challenges is that you have small businesses that have really great ideas, and there's really, because how we look at it is every building, whether it's remodel or existing, it's a project, right? So we're not creating the same thing over and over again. We have to do our due diligence to say, okay, how are we going to make this building more efficient, right? And a lot of times what I see happening is there's the upfront costs that are associated with that, right? And no one, either because it's unable to articulate it to the investor, right? So then there's no investment there, or we just it doesn't seem like it's going to have a return on the investment. Once it gets going, and I see this with a lot of the small businesses we work with, then there's an interest in investing in that business, right? And in supporting it. But we don't see it in the front end, where it would really be helpful on the front end, because I think what happens with the business is it just takes them longer to ramp up and ramp the scale, because it's that ability to not get that initial investment to understand what the outcomes would be if that investment happened early on.
Great, thank you. All right, so I've got a final question for the three of you. So in just a couple of minutes, we have another panel coming up. It's a group of people who all represent different types of impact investing capital that has the potential to make a significant impact on addressing the climate crisis. And I'm curious, I know for a fact they're all interested in figuring out how to move large pools of capital to solving this problem in the most effective way, and sort of in a very dynamic, changing landscape. And I'm wondering if you could sort of offer some advice to the next panel. What would you like to see them do to steer capital, ranging from individual angel investment capital to venture capital to large sources of philanthropic capital? How can they direct that to the right places? Allison, do you want to start?
Yeah, sure. I think spreading the word is something that folks can do to help investors realize that there is a spectrum upon which you can invest. I think a lot of investors don't recognize that you can invest in climate tech startups through your donor advised fund, for example. And most angel investors are familiar with the conventional modes of market rate investing, but there are actually many ways that you can put your money to work, including philanthropic dollars. Also, I think increasing access to investing is critical. I'm seeing with angel groups the growth of special purpose vehicles that allow people to pool their money to come into a deal if they're not prepared to invest at what's typically a $25,000 minimum for angel deals. So it's exciting to see the growth of special purpose vehicles and likewise crowdfunding vehicles where you may not even need to be an accredited investor to invest in early stage climate tech startups.
Thank you. Jane?
Great points, Alison. So I agree with those. I wanted to add one from the perspective of the CEO and prime fundraiser of my company, which is streamlining the process. And I know there are efforts made to do that. There are portals such as Gust and others which do make things easier. But if we can streamline the process so investors can access the information they need to make an informed decision, but that allows the company to reach out efficiently while still being able to manage and move forward with the company. Raising funds can be a full-time job, and of course, no CEO in an early stage company can really do that, and so it's a challenge.
Thanks, Jane. And Maurice, I'll give you the final word here.
And I would say, yeah, I would say just cast in a wider net, right? And really challenge yourself to look at companies. If they don't have tech in the back of their name, doesn't mean that they're not in that field. So really kind of looking beyond what you normally look at and really leaning inwards and seeing and hearing what that company's doing. Because I think what you'll find is that there's a lot of companies out there that are working in the arena that just historically haven't had access to capital. So I'll leave it at that.
Great, thank you. Maurice, Alison, and Jane, thank you so much for your time today. This is a really interesting panel. I hope everyone listening got some really good nuggets of insight from all of you. Appreciate your participation. We're going to wrap this panel up now, and I'm going to transition the hosting duties over to Ken Vaughn, the Director of Impact Investments for Virtue Lab, who's going to introduce the next panel.
Yeah, thank you, David. And let me add my thanks to the audience for joining us here today. And a special thanks to the next panel that is going to talk. You've heard a little bit about this idea of impact investing. That's a little bit of an umbrella term that means different things to different people. And so we're going to have a panel here today that is going to bring perspectives from different types of impact investors. And first, let me just introduce myself, and then I'll ask our panelists to join and do a little brief introduction of themselves before we kick things off. So I'm the Director of Impact Investments at Virtue Lab. I've been with the organization for coming up on 11 years, and I started our program to fund early stage startups for mission purposes, in our case to address big environmental challenges like climate change, and also to grow the green economy. And we have, over the years, gone from being a grant maker, making grants to startups, to investing in companies using capital from governmental economic development sources, to now investing in startups using capital primarily from philanthropic sources. And so you're going to hear a bit about that. So maybe we can have the other panelists join this stage. Great. So I'm going to just go around the group here and have them say, introduce themselves and their title and a little bit about their organization. And I'll start with Brad Harrison, and he's going to be talking to us today about the perspective from foundations and how foundations think about impact investing related to climate tech. Brad?
Hey, Ken. Thanks for having me. My name is Brad Harrison. I'm a managing director and a partner at Tiedemann Advisors. We're about a $30 billion multifamily office, which essentially means we advise ultra-affluent families, multi-generational families, trusts, private foundations, and nonprofit organizations on everything to do with investing, from being an outsourced chief investment officer to trust and estate planning, to impact investing, which is the group that I co-lead for the firm. And we explicitly focus on this concept of total portfolio activation, ultimately activating all assets in line with mission, and particularly focus on climate sustainability and inclusive innovation. So thanks again for having me.
Great, thank you. So next we'll have Chad Bullock introduce himself. So he's going to be talking to us. You may have heard in the prior panel a mention of investing in startups through a donor advised fund. And I'm sure there might be some folks in the audience that don't even know what that is. And we'll be diving into that a little bit more in a few minutes. But first, Chad, if you could introduce yourself.
Sure, Ken. It's a pleasure to be here. Thank you so much for having me. So I am the head of philanthropy management at Morgan Stanley within our private wealth management group. And essentially that means that I work with a small subset of the firm's clients on all aspects of their philanthropy, really, often from an initial stage of selecting the right tool or the right set of tools to aligning, the issues, the geographies, and the guiding philosophies that are really important to individuals and families around their philanthropy. And then from there, it can go in a lot of different directions, everything from board service to increasingly intergenerational wealth transfer, which is one of the things that I'm really excited about in the context of climate and some of the various lenses that we're using. But it's a pleasure to be here.
Thank you, Chad. So next we'll hear from Jordana Pleat. So if you haven't heard about donor advised funds and how they invest in early stage companies, you probably also haven't heard about intermediaries who help to enable that with some of the big firms like Morgan Stanley. Jordana, can you introduce yourself?
Thanks, Ken. I'm Jordana Pleat, Senior Director of Impact Investments here at CapShift. For those who may be less familiar with our work, CapShift is an impact investing platform that provides a suite of impact solutions to families, donor advised fund providers, and financial advisors. We work with asset owners like donor advised funds, including Morgan Stanley Gift, on helping their clients discover, review, and manage impact investments and recoverable grant opportunities.
Thank you, Georgiana. And our last panelist, I want to hear, we'll have Kathleen Aber introduce herself. And you could probably think of angels investing in clean tech as maybe the original impact investors in the climate tech space. And so, Kathleen, could you introduce yourself?
Thanks, Ken. I'm Kathleen Aber. I'm with E8, which is, as Ken was pointing out, the largest early stage investment organization that is 100% focused on climate tech. We're headquartered in Seattle, Washington. And I am on the board of E8. I'm also a governor with the Decarbonate Fund, and I'm a senior venture partner with E8 Ventures. And our sole focus is navigating that path of investing from early stage pilot phase all the way through to commercialization for climate companies.
Thank you, Kathleen. And I'll just do a little bit more context setting here, and then we'll go around and get the perspectives from our different panelists. So as you probably gathered by now, there are different kind of impact investors. The way I think of it is it's a bit of a spectrum. You can think of pure philanthropy on one end of the spectrum and pure financial investing on the other end of the spectrum. And in between there is what I think of as impact investing. And so you could have some investors who are more focused on one end of that spectrum where they're trying to achieve market rate financial returns adjusted for the risk of investing in early stage companies, but they also want to get impact along with that. And then maybe on the other end of the spectrum, you have investors that are investing for impact, but they'd also like to get financial return if they can at the same time. So it's closer to pure philanthropy. And that style of impact first investing is what Virtue Lab does. So among our panelists here, we have a lot of different types of impact investors, including a nonprofit impact investor, which is Virtue Lab, and through our Climate Impact Fund that we're investing out of right now, and our second fund that will be opening very shortly for new investment from sources of capital. We take a different perspective than somebody who might be at the other end of that spectrum. So first, let's start with thinking about this from the perspective of foundations, and we'll get Brad to weigh in on this. And I would say when we first started launching our impact investing fund, going back about 4 years or so ago, and I started asking around in our networks about impact investing, which was kind of a new idea to us, even though we had been doing it, we didn't know the name for it. And started asking around the networks, and after a while, I heard 2 or 3 people say the same thing, which was, you want to learn about impact investing, you got to talk to Brad Harrison. He had been a thought leader in the space, working with foundations as a wealth advisor, and has been a friend and sounding board to us ever since, and we really appreciate it. So Brad, foundations have really been sort of leading the charge to some extent with the whole concept of impact investing. Is that still gaining steam within philanthropy? Can you say a little bit more about the general trend there?
Yeah, well, first I'll begin by, thank you, Ken. It's been a pleasure getting to know you and appreciate all that you're doing at Virtue Lab. Always happy to be a sounding board for you, and excited about the launch of the next fund. I'll begin with a resounding yes, very much so. Foundations are still leading the way in impact investing. It's true that many of the foundations that we think about nationally, like Ford and Rockefeller, McKnight and Heron, and others have really charted this path for foundations of all shapes and sizes to engage. Many are just starting along this path of aligning their portfolio with mission, and others have fully aligned 100% of their assets with their charitable purpose. So just in the next few minutes, I'd be happy to share some brief insights on tax-exempt entities, what we're seeing, particularly private foundations aligning their assets with their mission and building out really exciting impact portfolios. But back to your question, I think it makes a lot of sense that foundations have been leaders in this space, particularly because foundations have very distinct mission statements, be it solving the climate crisis or building affordable housing, local community economic development, diversity, equity, and inclusion. You can very clearly point to that mission and start aligning the portfolio with it. And while there are a lot of investable opportunities across those areas, we think it's a somewhat simple exercise to get started on identifying investments for what we call the other 95% of the portfolio. And many have heard this concept before. It's really not new or novel to me at all. But we don't think it makes a whole lot of sense to be invested in things in the broader foundation's endowment or portfolio that would run counter or even contribute to the problems that you're trying to solve with philanthropic capital. That's sort of the notion of mission-related investing or to a further extent, impact investing. And most of the foundations that we're seeing in the impact space are practicing a concept that we call total portfolio activation or total portfolio management. And really what this means is aligning all assets of the portfolio in all asset classes is with mission, and be it equities or fixed income, hedge funds, alternatives, private equity, venture capital, and cash, really all assets that a typical endowment would be invested in. And within the impact space in particular, there are a variety of mechanisms that we see foundations using. Many foundations start aligning cash and fixed income with local community economic development. In public markets, essentially applying screens and tilts to move portfolios away from things that are maybe contributing to the climate crisis, like fossil fuels or other highly carbon intensive sectors. And using shareholder advocacy, which is brought up on the prior panel, to advance the transition to net zero. But maybe in private markets, more interesting, where Virtue Lab is investing, we're seeing a surge of what we call thematic or catalytic impact investments, directly in line with themes like climate solutions and in the inclusive innovation space. But It's an interesting time for foundations, but I would argue asset owners of all types to be pursuing impact investing, not just for social and environmental benefits, but also for the return potential that these can generate.
But I think I'm hearing, but I wanted to see if I'm right about this, that now that the climate crisis is becoming much more obvious to everyone, it's happening to us. It's here. It's not some future abstract thing. But we've heard that historically in philanthropy, that foundations have only been looking at climate with about 2% of their philanthropy. Are you seeing that growing? Are you seeing that foundations in general that maybe were not so focused on climate change are now making that part of their portfolio?
I think so. I advise foundations that are focused on climate change, is also advising foundations that are focused on other socioeconomic development issues. And I'm seeing climate-oriented investments become a bigger and broader part of the investment portfolio, not just due to the urgency of the climate crisis, but really the potentially huge investment opportunity that it presents, really for better or worse. And again, this is occurring across asset classes in various ways. The top three themes that we're seeing embedded into foundation portfolios, be it climate-oriented foundations or otherwise, are decarbonization technology plays. So these would be really focused on the energy transition, infrastructure, electric vehicles, various forms of artificial intelligence for climate mitigation, adaptation, renewables. And I would put these in the bucket of deep decarbonization technologies, opportunities to reduce CO2 and methane. The second category that we're seeing a big increase in are what we call nature-based solutions. These are regenerative agriculture, sustainable timber, ecosystem service markets, which are focused on carbon and biodiversity and water. Again, these investments have the opportunity not just to decarbonize, but essentially sequester CO2 and methane as they play out. And then the third area, in really at the intersection of climate and diversity, equity, and inclusion, is environmental justice, workforce development, access to energy efficiency programs, green banks. And it's not just the urgency of the problem that we're seeing in the physical world, but policy and regulatory changes are here. This was again discussed a little bit on the last panel, that have large economic incentives to be investing in this space. Really coming out of COP26 and recent emissions disclosures that were proposed by the SEC, we're seeing foundations and other asset owners match the goals of over 2,000 publicly traded companies that have pledged to become net zero or carbon neutral over time. And as investment advisors, we're particularly interested in this type of transparency and reporting accuracy, so we can optimize portfolios again across asset classes. I'll make one last point, and probably something we'll continue discussing because it was touched on in the last session. There's a renewed sense of urgency with the economic tailwinds of the Inflation Reduction Act. This was a huge bill that's discussed. There were $350 billion in climate investments, the largest the US has ever made, mobilizing private capital. When you combine this with the CHIPS Act and the Job Act, the scale is really massive. Just a couple of points: the investment tax credits and the production tax credits, which were touched on, are extended for 10 years. $3 a ton tax credits for clean hydrogen. This 45Q tax credit that gets discussed a lot for point source carbon capture increased from $45 to $85. I mean, it's really economically very interesting to be investing in this space. All that to say, a lot of these tailwinds are pushing, I think, investors of all shapes and sizes into the climate investment space.
Great, thank you, Brad. Let's shift over to Chad and get a perspective from the world of donor advised funds. And Chad, maybe you could just start off by saying a little bit more about what is a donor advised fund and why are they growing so fast?
It's a great question, Ken. Again, glad to be here. Good afternoon, everyone. I'm joining from the Bay Area today. We're no stranger to natural disasters here in California. And I'm just thinking about our friends around the world who are enduring all sorts of extreme weather events at the moment, and the role that we can play in resilience and bouncing back. So with that, Ken, I'll talk a little bit more about donor advised funds. So for those of you who are not familiar with DAFs or donor advised funds, they've really become the vehicle of choice for charitable giving over the past decade. Though they first originated in the early 30s in New York in response to the Great Depression. So what exactly is a DAF? In simplest terms, I like to refer to them as a charitable checking account. A donor, the D in donor advised fund, is about an irrevocable gift made to a public charity for which the donor receives an immediate upfront tax deduction. This deduction varies based on whether a donor is contributing cash or other complex asset like a highly appreciated stock or real estate, cryptocurrency, basically anything that can be assigned a value and ultimately liquidated. The A is interesting. The A is for advised, and that really conveys the ability of the donor to continue to advise the public charity hosts like MS Gift, the donor advised fund that we have at Morgan Stanley. And this public charity host, they receive and administer that gift. And 99% of the time, as long as a donor recommends, or again, back to that A for advises, a gift to qualified 501c3 public charity, the administrator complies and moves the money to a charity of choice, either with the name of the donor acknowledged or anonymously, which is important to a number of our clients. The F for fund is important because the assets in a DAF also fall under the rights of the donor's advisory privileges. That is essentially how the assets in the DAF are invested to support and expand charitable giving. And I think most importantly, DAF assets appreciate tax-free until the donor is ready to make a grant. So at Morgan Stanley, I mentioned MS Gift, our DAF, Morgan Stanley Global Impact Funding Trust, another acronym. It's our in-house DAF, primarily focused on a group of mass affluent clients at the firm who use this tool. But before we talk about why it's so popular, I thought, Ken, maybe a few stats to ground us in the current state of DAFs in the US would be useful. So there's a great report that comes out every year, NPT, the National Philanthropic Trust. And in their 2021 report, covering the year 2020, there are a few interesting morsels baked into that report. So first, the value of grants from donor advised funds to charities was $35 billion in 2020, and that was 27% higher than 2019. And those are numbers that are pretty familiar in terms of growth each year over the past decade. Secondly, contributions made to DAF accounts totaled $48 billion in 2020. So that's over a 20% increase over 2019. And total charitable assets as of the end of 2020 in DAFs were around $160 billion. I would guess with the percentages that we're talking about in terms of increase and market gyration, we're probably near the 200 billion mark at this point. And then also in 2020, the actual total number of DAF accounts, from in-house shops like Morgan Stanley Gift to some of the retail players like Vanguard, Schwab, Fidelity, that number of individual accounts surpassed 1 million for the first time. So I think that is rather easy to dissect their popularity. It's really the ease of management and the general flexibility of DAFs, including, I'd say, the level of tax efficiency relative to our stalwart friends, the private foundation that Brad is talking about, although they really do differ quite significantly in terms of the complexity and the sophistication of the tools that are at the disposal of each. And I think also the rise of a couple other things, workplace giving programs. We've seen lower account minimum setups, and also, I think and our team felt this acutely, the enormity of the crisis during the pandemic. I think this really all helped accelerate an existing trend. And certainly from my perch here in Silicon Valley, it's also been easy to connect high levels of new wealth creation with the rise of dApps. I think particularly while setting the stage for current and future giving, they're offsetting taxes in high income years, which many entrepreneurs are interested in. But as donors evolve, this very often expands. dApps expand into other tools as well. Everything from foundations to we spend an increasing amount of time thinking about charitable LLCs. And many of the entities that we're familiar out there, newly set up philanthropic structures, are not really foundations at all. Whether they call themselves foundations, it's often a DAF really working in parallel with a for-profit business sidecar. Lastly, there are two things that I think are really important to mention here as well, markers that I think are useful. The average DAF account size is about 160,000, and the average payout rate on an annual basis is about 22%. So I say that I think it's important to call that out, because there's also, if you're a nonprofit sector news junkie like I am, there's a lot of controversy swirling around DAFs and payout rates. And I mean, from our perspective, based on the numbers, we would be concerned or cautious about mandatory payout rates considering where they're at, because we're also very sensitive to anything that would deter people from giving more as well. And I think when we look upon the landscape of what our donors are doing, from traditional philanthropy to some of the cooler things we're going to talk about today, there are definitely things we've changed. But the guiding light for us is really effective philanthropy, and that's the core mission of the team. So hopefully that's helped kind of tee us up.
Yeah, thanks so much, Chad. Let's draw Jordana into this conversation more about DAFs. And we're hearing some really great things, and this has been true of us as well at Virtual Lab in being able to raise capital through donor advised funds. But Jordana, maybe you could talk a little bit about the role of an intermediary between a donor advised fund platform and an unconventional fund like ours. What role does an intermediary play, and why is it needed?
Sure. Thanks, Ken. Thank you, Chad. The CapShift was started really with the understanding that around 45% of high net worth individuals are interested in impact investing, but when you look at the data, only closer to 13% are actually succeeding in adding impact investments in their portfolio. We find typically this is because a number of barriers still remain, whether it's knowledge gaps to find and vet the high quality opportunities, or a lack of familiarity or comfort by their trusted financial advisors to allocate to those opportunities. And so CapShift was founded as an intermediary to address those gaps by providing a full service platform for both financial institutions like donor advised funds or financial advisors and their underlying clients to access simpler ways, whether it's to discover, review, or manage impact investments and recoverable grant opportunities. So CapShift, as an intermediary, we've grown a database of now close to 1,600 private, public, and recoverable grant impact opportunities, really ranging across the full continuum of risk, return, and impact, and are now working with over half of the largest donor advised funds in the country by AUM, including Chad and team over at Morgan Stanley Gift to mobilize capital for purpose. Ken, I think the second half of your question was really around unlocking that unconventional and impact, more capital for impact-oriented funds. And I would echo, as Allison mentioned in the previous panel, really, more awareness needed, first and foremost at the individual level. I think we similarly have found that many individuals don't even know they can leverage their assets in their donor advised fund for anything other than pure grant making. Many may not be traditionally even thinking of this pool of capital for any other investment uses. And so I'd say, if you're a fund, a nonprofit, a company, First and foremost, I would say ask your existing base of donors or investors if they have interest in using their charitable capital for these purposes beyond pure grant making. And similarly, if you're an investor or a donor and you have a DAF or foundation, asking your advisors what options may be available to you, whether it's through impact investments on the investment side of a donor advised fund or a recoverable grant, within the grant making allocation, really to provide catalytic capital to, truly high impact and unique funds out there. I'd say in our experience as an intermediary here at CapShift, we have found that oftentimes institutions are most ready and willing and able for change, really because of the interests and needs of their underlying clients. And of course, if you have a DAF or a foundation, feel free to reach out to us and we'd be happy to discuss ways we can support.
Thank you, Jordana. Let me draw in Kathleen to this conversation. We've been talking a fair amount here about charitable kind of investing, philanthropic style investing, things like impact first investing, recoverable grants, concessionary returns, some of the things that sound a lot closer to philanthropy. But let's get a little bit of a perspective from the other end of that spectrum that I introduced earlier, which is people that are investing either their own money or their limited partners' money to make money in the clean tech or climate tech space. So Kathleen, maybe just give us a kind of broad brush picture of what has been generally the experience of market rate investors investing in the clean tech or climate tech space in your experience.
Thanks, Ken. And I have to say there are returns to be had. So that's the good news. In the last decade, you've seen an influx of capital into this early stage investing. And early stage really occupies the space between proof of an idea and commercialization. So it's that great gulf that exists where when you talk about 60% of companies and startups failing, they usually fail in that gulf, that span from proof of the product to through pilots and actually getting it into the marketplace. And so it requires patient capital, and it requires, some eye to what your goals are. Most returns when you're investing on an early stage investment don't start accruing for, 7 or more years, especially if you've been in the early stages when it's just past proof and the initial IP. But also what we've seen is over the last decade that it requires patient capital because in the climate space, we are replacing infrastructure. So investment capital and venture capital was originally invented to really address software, something that could be turned around in just 2 years and brought to market. But when we are looking at new products that are disrupting the marketplace and replacing infrastructure, it often takes many years, not only of development, but also to unseat the status quo. So when we've seen it over the last decade, there's been steady growth, in particular in the last couple of years since post-pandemic. During pandemic and post, we've seen a rush toward the climate space, which has been welcome. And I think it's a recognition that there are returns to be had.
You mentioned earlier a new initiative at E8 called Decarbonate, which is a new option for the members to invest through using their philanthropic capital. Say a little more about why that was done and how that's going.
Well, Decarbonate is near and dear to my heart because it was a fund started by E8 that recognized that people not only wanted to put their investment capital into climate tech, but if that was your goal as an individual, you might want to align also your mission-related investments and philanthropic dollars toward the same goals. And so you can invest in early stage capital in your own for-profit dollars, but Decarbonate is our vehicle that we started that would allow you to invest your philanthropic, your donor advised funds, your family office, et cetera, dollars against those same mission-driven goals that you have. with the idea that you can enjoy market returns and potentially have even more investment capital at the end to continue to apply against these trends. And since we are an annual fund, we have a different theme every year. We started 3 years ago with general decarbonization, and we actually have had an exit. We don't usually have an exit after just 2 years, but we had an exit from our fund 3 years ago. Last year, the fund was focused on transportation, and this year it was on agriculture broadly, both green tech and blue tech. And I'd like to say it's interesting to see all these areas, and as we are exposing these areas, both through E8 as well as Decarbonate, one of the areas that is near and dear to my heart is kind of focusing on part of the greenhouse gas reductions that can move the dial the most. When we've seen people enter the investment capital area, what we often see is a kind of a scrum mentality. Back in the early 2010s, it was all about wind, and then mid 2010s, it was all about solar, and then late 2010s, it was all about battery technologies, and then most recently, it was e-mobility. But when you look at something like e-mobility, which happened to attract 61% of venture capital in the span of 2021 and 2022, it really only represents 16% of potential reduction of GHGs. And so being able to align the capital against the maybe 80% of the market that currently only gets 25% of the capital is a really important focus. And so by having annual funds that can draw attention to areas that may be in need of more capital but have greater potential for GHG reduction is also an incredible goal. In addition, one last point with Decarbonate, since it's both philanthropic, we have no minimums that are required. Often you have to be a qualified investor in order to get into early stage investing. But with something like Decarbonate, someone can get invested at any level. You don't have a, maybe 25,000 minimum that is required.
Great, thanks very much for that. And let's bring in the rest of the panel here and go around on one question for everybody on the panel. And I'll just have each of you speak to this question, starting with Brad and then Chad and then Jordana and then Kathleen. And so we've been talking a lot about climate and climate impact, but in your world, how are climate-focused investors incorporating other factors like social impact factors, diversity, economic impact factors into their thinking? Brad?
Thanks, Ken. It's hard to find a high quality impact investment in the climate space that is, really to be investable, you'd want it to be focused broadly on diversity, equity, and inclusion as well. There's so much data suggests that these are better managed companies that perform better over the long term if they have a diverse perspective of folks with lived experience in the space. That's sort of point number one. Point number two is as we're conducting diligence on private equity funds, venture funds, direct investments into companies and the like, we're really asking deeper questions around diversity, equity, and inclusion policies and practices at the firm, not only on the composition of boards and teams and staff, but hiring practices over time, and then how these can be reported out back to investors. And I think, in our diligence with Virtue Lab, even we had asked those types of questions, and we really saw you all develop policies and practices that we got, really comfortable with and excited about, not just, what you're all doing in the climate tech space, but how you're advancing a more equitable Pacific Northwest and beyond.
Good. Sorry, Chad, do you want to address the same question? We may be having a technical difficulty. Jordana, if you hopefully can hear me, what are your thoughts on that?
Sure. So I think it totally echo, what Brad had shared. And I think it's critical to just realize the intersectionality between both climate investing and investing for equity and justice. Black Americans are 40% more likely to live in areas with the highest projected increase in extreme temperature-related deaths. Similarly, Latinx Americans are 43% more likely to live in areas with the highest projected reduction in labor hours due to extreme temperatures. And we've seen a number of really interesting, innovative opportunities looking to push the needle in addressing both social and racial equity in a just climate transition. So whether you're an investor looking to support climate justice or an entrepreneur looking for models to incorporate climate justice into your work, I think two really innovative models we've seen, first and foremost, ensuring that the benefits of climate solutions are shared equitably. So CapShift has worked with one for-profit company, actually, that's specifically focused on investing in community-based solar projects in low-income and communities of color across the United States. They're focused on financing solar projects, bringing clean power, cost savings, and quality jobs. But the additionality of their work is that they really are bringing that work to areas of the country that otherwise wouldn't have had access. A second innovative model we've seen is really thinking about how to build up community resilience against the climate crisis. So one lender that we've worked with supports rural women and BIPOC producers, processors, and packagers to help them finance loans to support a transition to regenerative practices, helping them transform a food system into one that's regenerative, healthy, and resilient. I think more broadly, climate specific and really anything that CapShift is looking at, we have developed a 3-part framework to be thinking about how equity, inclusion, and justice shows up in both investments and recoverable grants we look at. So whether an opportunity is focused on diversity and inclusion, right? So bringing more diverse stakeholders into the fold, racial equity, trying to level the playing field, or really deep racial justice, actually challenging the very systems and notions that presented such inequality and looking to flip those systems in and on its head. So I think there are a number of interesting models specifically in the climate space and impact investing more broadly to be thinking about a just transition and future.
Yeah, thanks. And Kathleen, are you seeing a similar trend in the world of angels and VCs?
Absolutely. And it comes from both lens are applied, both in terms of looking at the team itself. There are lots of requirements as we evaluate investments now that require a diversity, equity, and inclusion lens on the culture of the company itself internally, but also on deployment of the solution, whether it's reaching communities of need, rural communities, et cetera. Because as we look at GHG reduction, it needs to happen not just amongst the areas that might be early adopters, but the people who are being most hard hit by the climate changes. In addition to that, I would say 2 factors that are fueling that, and it's already been mentioned multiple times, but the Inflation Reduction Act is going to really supercharge markets and targeting it toward people as well that are going to be hardest hit, and given the economic relief that will build these markets and speed the transition. And then I'll add one that we haven't talked about a lot that is actually becoming more and more critical, and that's participation by corporate partners. 25% of venture capital deals in 2022 had a corporate partner investing alongside. And the reason why these corporations are doing it is not just internally, they're finding DEI issues being an important part of the equation of how they run their company. But as they look at changes in the earth, where they can make the biggest impact is often in communities of need.
Great, thanks. And I'm going to, Chad, I'm going to flip the script a little bit here. We're just about out of time, but there was a question from the audience, and it's similar to a question that I had. So just briefly, somebody asked the question. I assume they're an entrepreneur asking the question. How do you get on the radar of all these forms of of impact investing? So I would just say, with regard to E8 or with regard to Virtual Lab, we have a website portal and an application form, and we're reasonably accessible and happy to chat with you. But Chad, a question for you would be, as a fund manager looking to tap into this type of capital coming from donor advised funds, we don't have access to all of your donors and your clients. So what are you doing as a platform to try to expose your donors to thematic investing like in climate tech?
Yeah, it's a great question, and I think that it actually starts with a shift that we're seeing right now, Ken, particularly with intergenerational wealth transfer. So I think for the longest time, this felt like a very theoretical conversation. We were talking about this is coming, it's coming, it's coming, and it's here, and it's happening every day. And I've had conversations that used to be monthly or quarterly that are now weekly, with foundations that are in transition, many of whom have donor advised funds, some simply donor advised funds. Conversations about, okay, we're an education focused organization, but we want to bring next gen in. What are the lenses that we can be using? And this is where things like climate and DEI are becoming increasingly important. I think that to the entrepreneur stepping into the sector, it feels exciting, but disconnected and disjointed. And what I found to be really useful in terms of having those conversations, in addition to this one, and like organizations, are peer networks. Organizations like the Climate Leadership Initiative, like the Action Labs that the Philanthropy Workshop is running, where you have a large group of people with extraordinary access to philanthropic capital, who increasingly are inclined to think about philanthropic capital as the highest form of risk capital, which is the way we see philanthropic capital. Don't pretend your DAF or your foundation is an endowment to be managed with, a 5% payout target. Think big, and invest big. And increasingly, I see the next gen really leading the charge there. Because, by the way, we're also getting a tremendous uptick in interest in climate giving, both on the nonprofit side, but as well as through, guides that we produce, around issues. For example, we did a racial equity guide earlier this year. In addition to having a menu of nonprofit organizations focused on financial empowerment, we also worked with CapShift to develop options, recoverable grant options that were also a part of that menu. And we're doing the same thing at the moment on the climate front as well.
Thank you so much. We're at time. We're a little over. Thank you so much to this panel. This has been super interesting. Thanks to our audience and to our sponsors. And I would just say that if you had interest in learning more about our Climate Impact Fund 2 that's coming soon, you can sign up on our website to get more information about that. And with that, we'll say good afternoon, everybody, and thanks for joining us.
Thank you, Ken.
Thanks, everyone.
Thank you, everyone.